Benjamin Franklin famously said that there are only two things that are certain in life: death and taxes. That being said, it's best to understand the second one: death can wait. Taxes are very much a now problem. Because of this, we're going to have a look at the two main categories of taxes, and then a look at the best ways of saving on these without an untimely visit from the IRS. There are two main types of taxes: direct and indirect. For direct, the clue is in the name. These are taxes that you pay directly to the government. Examples include income tax, real property tax, personal property tax, and taxes on assets. Using the US as a case study, these kinds of taxes are based on the ability to pay principle. This states that those who have more resources or earn a higher income should pay more tax burden. However, there will also be people who argue they should be paying even more. Some critics see this kind of tax as a disincentive for individuals to work hard and earn more money, because the more cash they can make it rain with, the more cash is taken away. The modern distinction between US direct taxes and indirect taxes came about with the ratification of the 16th Amendment to the US Constitution in 1913. Before this, the tax law in the states was written so that direct taxes had to be directly apportioned to the state's population. So this meant a state with a population that was 75% of the size of another state, for example, to 75% of the larger state's tax bill. This might seem antiquated and ridiculous, because it is. Then it created a situation in which the federal government could not receive many direct taxes, such as personal income tax. However, the introduction of the 16th Amendment and allowed for the levying of several direct and indirect taxes. Lucky us. Direct taxes will be different for each country, but there are a few general examples we can look at. First, income tax. This is where tax comes from someone's pay or earnings. A certain percentage is taken from a worker's salary, depending on how much they earn. This doesn't sound great, and it isn't if you want to keep your money. But the good thing is that the government is also keen on listing credits and deductions that help lower tax liabilities. Next is transfer tax, the most common of which is estate tax. This is levied on the taxable portion of the property of someone who's died, including trusts and financial accounts. A gift tax is also another that comes under the transfer bracket, where a certain amount is collected from people who are transferring properties to someone else. Then there's entitlement tax. This kind of direct tax is the reason why there can be social programs like Medicare, Medicaid, and Social Security. It's essentially the tax that helps fund universal benefits for the masses. These kinds of taxes are collected through payroll deductions, and in the US are collectively grouped as the Federal Insurance Contributions Act. Property tax is another direct levy and is charged on properties like land and buildings. Think monopoly, but real. This is used in the states for maintaining public services like the police and fire departments, schools and libraries, as well as roads. The last example is capital gains tax, where there's a premium due if someone sells assets like stocks, real estate, or a business. The tax is worked out by determining the difference between the acquisition amount and the selling amount. Direct taxes are always a source of debate, as they are strictly implemented on every individual who does not qualify for an exemption. But there are several advantages of this kind of tax. Firstly, it promotes equality. Since direct taxes are based on the ability of a person to pay, it encourages a level playing field amongst payers and citizens. Each person is charged a different amount based on their circumstances. Another advantage is that it promotes certainty. They are determined and made final before they're even paid. This gives a chance to plan. In the case of income tax, the annual bill is the same every year as long as the salary does not change. Because taxes are the earnings of the government, they promote flexibility. This means when they fluctuate, the earnings also change. They can go higher or lower depending on the money made. The final big advantage of direct taxes are just how simple they are and the fact that they can be automatically taken at source. The government doesn't have to spend so much on the collection of these taxes because they are already taken right at the source of income. Some companies also use automatic systems, which help save time and money. The other main type of tax is indirect. Put simply, this is a tax levied on goods and services rather than for an individual or company. However, this tax is passed on to the consumer by the manufacturer or retailer as part of the purchase price of a good or service. The person buying something is ultimately paying the tax by paying more for the product. Excise duties on fuel, liquor, and cigarettes are all considered examples of indirect taxes. These can be changed by the government to make more income if they so choose. Often things that are considered bad for the environment or health are taxed more to encourage a push towards alternatives. Like direct taxes, not everyone is their biggest fan. They could be known as regressive taxes because they're essentially fees that are levied equally upon taxpayers. So regardless of income, everyone has to pay them. This means that they can bear a heavy burden on people with lower incomes who end up paying the same amount of tax as those who make more money. For example, the import duty on a surround sound system from Japan will be the same amount regardless of the income of the person buying it. And because this levy has nothing to do with how much people make, this means someone who earns $30,000 a year will have to pay the same duty on the same system as someone who earns $150,000 a year. So you can see why a lot of people don't consider this fair. This example is particularly relevant because the most common example of an indirect tax is import duties. The fee is paid by the importer of a good at the time it enters the country. If the importer then resells the item to a consumer, the cost of this duty, in effect, is included in the price that the consumer pays. The consumer doesn't usually know that they are essentially paying this tax as part of their purchase. Sales taxes are more tricky to categorize as these can be indirect or direct. If they are levied only on the final supply to the customer, they are direct. If they are imposed as a value-added tax, or VAT, along the production process, then they are indirect. So now we know the different types of tax. How can we save on them without getting ourselves arrested? Again, this depends on where you live, but we'll use the US as the main example. Usually other countries have their own equivalent versions of these methods. So first, you could invest in municipal bonds. Governments need money to fund their obligations to their citizens, like building roads or public schools. They raise this money partly by selling securities or municipal bonds. The big advantage here is that, assuming you can hold the bond until maturity, you don't have to pay federal taxes on the interest. And you can avoid state and local taxes as well if you live in the area where the bond was issued. Starting a side business can also offer significant tax relief, as well as creating more income. Lots of expenses can be deducted from income when they're used in the course of daily business, which reduces total tax obligation. Often retirement accounts can offer significant tax relief to people that invest in them. This encourages more people to pump more money into their pots for later life. Max out as much tax relief as you can. In the US, this is the 401k or 403b. The more that can be pumped into these accounts, the less can be taken away in tax. Also in the US, there's what's known as tax credits. This is a huge perk that should definitely be taken advantage of. For example, maybe your overall income for the year was $50,000. You spend $8,000 of that on IRS-friendly deductible expenses. You'll pay your ordinary tax rate on the $42,000 left, assuming that none of the money was from long-term capital gains. Let's say you're also eligible for one or more tax credits, like $5,000 worth. That $5,000 doesn't reduce your taxable income. It comes directly off the tax you owe the IRS on that $42,000. This makes it a dollar-for-dollar perk. This is not an exhaustive list. There are plenty of other schemes that offer tax relief in the US, and no doubt there are others in whichever country you live in. Do your research and maximize the tax relief the government offers you. It's usually there to encourage you to save and invest, which is good for the national economy. So often there's no catch when it comes to these schemes. For the most part, they're usually a win-win for everyone. We really appreciate you watching this video, and you can support the channel with a like or subscribe. If there's anything you'd like us to make a video on next, please let us know in the comments. Thanks for watching.